Hello investors, welcome to our channel. Today we're going to talk about Nike, a name that's all about winning, new ideas and culture, one of the strongest brands on earth. But if you're an investor and you've been watching the market, you might have noticed the giant seems to have stumbled. Weak results, tough competition from new brands like Hoka and On, and a feeling in the market that Nike has lost some of its innovative magic. The stock shows this. The billion-dollar question is this the start of the end of an era, or the best chance to buy shares of a fantastic company at a discount? In this video, we're going to take a close look at Nike. We'll dive into its plan, its amazing competitive edge, its money health, the risks, and find out if, at its current price, Nike is a buy for the long-term investor. Stay with me until the end, because the conclusion might surprise you. Let's go! Our investment idea for Nike is clear and simple. Even with the short-term problems, which are real and we'll explain, we believe the company's new focus on its strong points, especially its unmatched brand, will lead to a big comeback. We think Nike has a wide economic moat, strong money health, and a plan that will get it growing again, making a lot of value for patient shareholders. We'll break down this idea into parts throughout the video. To understand the chance, we first need to understand the problem. Why is Nike struggling? There are three main reasons. First, not enough new ideas and too much stuff. The company admitted it needs to clear out too much of some products, especially shoes, to make room for newer, more exciting lines. Sales in the last quarter of fiscal year 2025, for example, dropped by 12%. This shows that customers are waiting for new things. Second, weak demand and fierce competition. The big economic picture, with high prices and interest rates, has hit customers' wallets. At the same time, new quick-moving brands like Hoka from Deckers and Swiss company On have taken market share, especially in running and everyday wear. Nike is no longer alone at the top. Third, strained relationships with wholesale partners. In recent years, Nike focused hard on selling directly to customers, DTC, cutting ties with many stores. While the idea was to control the brand and have bigger profits, the way they did it seems to have upset important partners, and the company lost valuable space on store shelves. Now, they need to fix these relationships. Okay, those are the problems. But Nike isn't just sitting around. Under the new CEO, Elliott Hill, who's been with the company for 30 years, they launched the Win Now strategy. What does that mean in real life? Pillar 1. New focus on partners. Nike is rebuilding relationships with its main wholesale partners, like Dick's Sporting Goods and JD Sports. The idea is to have the best of both worlds, a strong direct-to-consumer presence, and at the same time, be where customers shop, with the brand's image controlled. Pillar 2. New ideas for products at the center of everything. Clearing out old stock hurts in the short run, but it makes way for what Nike does best: launching products that set the trend. The company spends over $500 million a year on research and development, much more than Adidas, 170 million euros, and Puma, 92 million euros. We expect to see new technologies and cool designs in the coming years. Pillar 3. Connecting with global sports. Nike is making its ties with athletes and sports events stronger. This is the heart of the brand and its main way to advertise. It doesn't just sell shoes, it sells inspiration and top performance. This strategy is a smart course correction, aiming to balance digital with physical and new ideas with how products are sold. Now let's get to the main point of our idea: Nike's wide economic moat. This is why we believe it will bounce back. And this moat is built on something you can't touch: its brand. First, the numbers prove it. Nike's return on invested capital, ROIC, over the last 5 years has been 27% on average. That's way higher than its cost of capital, which is about 8%. This means for every dollar put into the business, it makes 27 cents back. Very few companies in the world can do this consistently. Nike is the biggest in the world, and by a lot. It has 16% of the global sports shoe market, almost double the second-place company, Adidas. In the United States, the biggest market, it has 15% compared to Adidas's 5%. In Europe, it's 17%. This global reach is huge. China is a huge chance. The Chinese government is spending a lot on sports, and the middle class keeps growing. Nike's sales in China jumped from $3.9 billion in 2016 to $6.6 billion in 2025. Even with local competition from Anta and Li Ning, Nike has 21% of the market and is set to gain a lot from the country's long-term growth. Nobody does marketing like Nike. It sponsors the biggest leagues, NFL, NBA, MLB, and the most famous athletes on the planet. Cristiano Ronaldo, LeBron James, Kevin Durant, all have lifetime contracts. This creates a level of visibility and trust that no amount of money can buy quickly. And of course, we can't forget the Jordan brand. More than 20 years after Michael Jordan retired, this sub-brand made over $7 billion in sales last fiscal year. It's the biggest sports marketing success story ever, and is still stronger than ever. Nike can charge more for its products. Many of its shoes cost over $150. Collaborations, like the one with Louis Vuitton, sold for $3,000 and are worth much more in the resale market today. This ability to set prices, pricing power, is the final proof of a brand's strength. A strong brand needs a solid financial base, and Nike has it. At the end of fiscal year 2025, the company had over $9 billion in cash versus $8 billion in debt. Basically, it operates with net cash. It also has $6 billion in unused credit lines. It's a financial fortress. Cash generation, Nike is a money-making machine. In the last 5 years, it made $25.6 billion in free cash flow, and the forecast for the next 5 years is even higher, $27.3 billion. This money funds new ideas, advertising, and returns to shareholders. Future predictions, the most important part. The near future will be weak. With clearing out old stock and the impact of import taxes, the gross profit margin in 2026 is expected to drop to 41%. Earnings per share are also expected to be lower, but look ahead. The prediction is that the gross profit margin will go back up to 46% by 2028 and reach 48% in the next 10 years. The operating profit margin, EBIT, which was only 7% in 2025, is expected to slowly climb to an impressive 17%. Sales growth is predicted to be 5% per year on average over the next decade, driven by China with 11% per year. The story here is short-term pain for long-term gain. No investment is without risks, and Nike's uncertainty rating has gone up from medium to high. We need to be honest about this. Risk 1, competition. As we already said, Hoka and On are real rivals and are growing fast. Nike needs to keep coming up with new ideas so it doesn't lose more ground. Risk 2, economic situation. As a global brand, Nike is at risk from recessions, rising prices, and changing money values. Spending on non-essential items is the first thing cut in tough times. Risk 3, tariffs and geopolitics. The company expects a $1 billion hit in costs due to new import taxes in the United States. Also, the controversy about forced labor in China is a constant political and reputation risk, especially in its fastest-growing market. Risk 4, getting things done. The Win Now plan looks good on paper, but the new CEO and his team need to carry it out perfectly. The turnaround isn't guaranteed. Lastly, how does Nike's management use shareholders' money? The answer is, in an excellent way. Smart acquisitions. Nike bought Converse in 2003 for just $305 million. Today, Converse makes $1.7 billion a year. At the same time, it knew how to sell brands that weren't important to its main business, like Cole Haan and Hurley, to focus on its core. Returns to shareholders. Nike is very friendly to its shareholders. Dividends. It pays about $2 billion in dividends every year. Share buybacks. In the last 4 years, the company bought back $14 billion worth of shares, and it has a new $15 billion program approved. In the last 10 years, the number of shares out there dropped by 17%. This means your piece as a shareholder became more valuable. Buying back shares when they are cheap, like now, creates a lot of value in the long run. This shows us a disciplined management focused and working for the shareholder. So, let's tie it all together. On one hand, we have Nike facing a drop in sales, squeezed profits in the short term, and tougher competition than ever. The next few quarters might not look pretty. But on the other hand, we have a company with a wide and lasting competitive edge based on the most iconic sports brand, perfect financial health, and a huge ability to make cash, a clear and smart recovery plan already happening, excellent management in using money and giving returns to shareholders, and significant long-term growth potential, especially in China. The verdict? For the patient investor with a 3, 5, or 10-year outlook, the current weakness in Nike's stock price seems like a good buying opportunity. You're buying one of the best companies in the world when people are feeling down about it. History shows that these are usually the best times to invest. Of course, this isn't advice to buy. Do your own research. But based on this analysis, Nike seems to be getting ready for another big win. And you? What do you think about Nike? Do you believe the company will turn things around? Leave your thoughts here in the comments. Let's talk about it. If you liked this video, don't forget to give it a thumbs up, subscribe to the channel, and turn on notifications so you don't miss our next videos. A big hug and happy investing.